Good afternoon, good morning, perhaps wherever you're listening to us from today. Glad to have you on another great educational webinar here at Advanta IRA, talking about something not necessarily self-directed IRA based, but something that's tangentially related to what we do when it comes to saving taxes and investing in real estate. So we have a great speaker coming on in a few moments to talk about 1031 exchanges. Again, not really needed for an IRA per se, but it is a great tax tool. That's why we like to present that information to our listeners. We have a great expert coming on today that I've known for several years to talk about the ins and outs of 1031 exchanges. My name is Scott Maurer. I'm the Vice President of Sales here for Advanta IRA. I've been here since 2006. Done a lot of different things in my role and my time here at Advanta IRA, but focused primarily now on business development and providing a lot of great education along with the team that we have on board to do that. If you have any questions for me during the webinar, you're welcome to type those into the question box. And actually, if you have any questions for our guest as well, there is a question box in the GoTo webinar control panel for you to use to ask questions of me, ask questions of our guest. But if you want to reach out to me after the webinar or at some other time, here is my contact information. You can either reach me by phone, by email. You can also go to our website, which is a wealth of really good information. Just a little bit about Advanta IRA for those of you who may not be familiar with our company. We've been around for over 20 years. We have over $3 billion in assets under management. And the only thing we do at Advanta IRA is administer self-directed retirement accounts, helping people who have IRAs, who have old 401ks, invest in a variety of different alternative assets, many of them real estate based. We offer a large we're really committed to kind of two things at Advanta. One is our customer service with our concierge level service with our account managers dedicated to helping you throughout your investments and throughout your account, but also really the education that we offer. We offer 1 to 2 webinars per week. We do a lot of live events. We're part of a lot of different real estate investment communities as well, so you'll hear us speaking at different places. We really want to educate folks, not only just our account holders, but others as well, on self-directed IRAs, on kind of different investment vehicles and different options, and things like today, also how to save taxes. Well, one of the main reasons people use self-directed IRAs in some instances is tax avoidance, not tax evasion, but tax avoidance with their self-directed IRA. So bringing on our guest today to talk about 1031 is just right in line with what we do from an educational perspective. We do have a great video library, a YouTube page. We're recording this webinar. We record all of our webinars and place those links on our YouTube page for later playback. Now, just a quick disclaimer, at Advanta IRA, we do not provide investment advice. We don't endorse any particular specific investments or products. Information and materials we present are for educational purposes. If you have tax legal questions or financial advice questions, you would need to consult with an attorney, a CPA, other professionals before making your decision. We're always happy to talk to you about the tax issues, maybe potentially talk to you about the legal issues involved with the self-directed IRA, what accounts you're looking to do or what investments you're looking to make. But as far as making those decisions, that's where you would want to rely on those outside parties. We can always give you, referrals to those individuals in that specific field that you need. Just very quickly, a high-level overview what a self-directed IRA is. It's an account in which the IRA account owner has complete control over what they want to invest in and the investment decisions. You're not being pigeonholed into the investments being offered by the custodian. Like brokerage firms most often allow you to invest in a lot of different types of mutual funds or stocks, but you cannot invest on their platform into real estate, mortgages, private placement, precious metals, foreign currencies, just so many different assets that you can hold inside of an IRA account, but not every custodian is willing to hold all of those assets. As I mentioned, most IRAs are held with banks or brokerage firms who are offering you only the products that they have available on their platform. It's not that you can't invest in real estate through a Schwab account if you potentially, except that Schwab does not allow you to do it. Fidelity, Vanguard, those companies could allow for these investments. They choose not to do it. That's why companies like Advanta IRA exist, is to hold this very broad range of investments the IRS permits. In fact, IRS, the only two investment categories prohibited to be held inside of an IRA are either life insurance products or collectibles like artwork, antiques. So anything outside of those two categories, you can hold as an investment in your IRA, but again, you have to have a custodian who is willing to hold that particular asset. That's where Advanta comes in with the real estate, private equity, precious metals, and so much more. Now, as far as what accounts you could self-direct when it comes to retirement accounts, any type of IRA, traditional or Roth, SEP or simple if you're a self-employed individual or own a small business. The SEP and the simple are tax-deferred entities, just like a traditional IRA, just have different contribution levels. Any former employer plan, like an old 401k, an old 403b, an old 457 plan, you can certainly self-direct the accounts and the funds in those particular accounts as well and roll those into a traditional or a Roth IRA. We also offer solo 401k or individual K plans for people who own their own business. You don't have employees. You can start your own 401k plan and take advantage of the larger contribution limits, the ability to make Roth contributions, and so much more. So the short end of this slide really is any type of IRA can be self-directed. Any former employer plan can be self-directed. And if you are self-employed, look at a SEP, a simple, or a solo 401k plan as a way to maximize your annual contributions to an account in a given year. So the one question we do get over the years, why do people choose self-direction? Why do they choose to take some of the retirement funds and invest in alternative assets and going down that self-directed path? I think probably three main reasons people over the years have chose to self-direct their retirement account. One, for many people, IRAs, their IRA funds, their old 401k funds simply provide them with the capital they need for a specific investment. They may be presented with an investment opportunity, maybe into a multifamily syndication, maybe into a private equity fund, maybe they want to buy a rental property down the street, and the cash in their IRA is available, and that's the money they choose to use so that they don't miss out on that particular investment opportunity. For many people, there's the aspect of the stock market fatigue. You know, markets go up and down. I'm sure many people on the call through your lifetime, you've seen new highs in the stock market. You've also seen quite a number of dips here and there. And so for a lot of folks, self-direction allows them to take some of their money off that stock market roller coaster and into investments that they know, they understand, and perhaps that they can control much better. So again, for a lot of people, it's just, hey, this is where my money's at. I'd rather use my IRA funds, not my personal savings account. And at the same time, I'd like to get this money invested elsewhere from the stock market. The last reason people choose to self-direct for the most part are the tax benefits. And that's the fact that the benefits of an investment, when you invest through an IRA account, whether you're buying real estate, whether you're buying stocks and bonds, whether you're investing in gold and silver, the benefits of the investment, the income, the rents, the dividends, the profits that you make from your investments go back to your IRA, either tax deferred or tax free, depending on the type of IRA account that you have. So for example, if you had an investment opportunity that was going to have a very large return in a given year, you may choose to make that investment through your IRA account and then continue to defer those taxes down the road and not have that tax hit now. And 1031 exchanges are another great tax tool, especially for real estate investors. And that's why we've had Dave Foster join us today to talk more specifically about 1031 exchanges. So an IRA account can be a 1031 exchange in itself. When you buy and sell within an IRA, there's no tax consequences. However, I'm sure many of you on the call, many of our clients hold assets outside of their IRA where a 1031 exchange will come into hand and come into great use. So we wanted to have Dave come on today to really talk about the 1031 exchange and kind of what's really involved with these accounts. So I'm going to turn the controls over to Dave. Here's his information on this slide, but I know he's going to share it as well.
Absolutely. Well, like I said, it's great to be here. It is kind of strange, isn't it, Scott? We are weird companions because our businesses really have nothing to do with each other. And yet at the same time, exactly what you said at the end, there's one common component, And that is that both the 1031 exchange and your qualified accounts as your self-directed IRAs all exist to mitigate taxes. So the best way to think about this is it's very easy to defer taxes inside your self-directed IRA. That just happens. But outside of your IRA, what can you do to get rid of those pesky taxes on profit from real estate transactions? And that's where the 1031 exchange comes in. Now we're going to try to blaze through this because at the end we've got a bunch of strategical types of movements that you can make. So I'm glad that Scott's recording this so you can go back. But we're going to try to just jump through this real quick and then give you some time to answer questions. So to ask questions. So with the 1031 exchange, when you're selling business or investment real estate that is outside of a qualified retirement account, you can still indefinitely defer paying the tax that normally would be due on the sale. So what does that let you do? It gives you the exact same benefit as your IRA would. You're compounding the return on that profit. Instead of paying the tax on the sale, that money stays with you. It's reinvested. You're making the benefit from it, whether it's inside the IRA or whether it's outside with the 1031 exchange. The key, of course, is that with the 1031 exchange, there are some very stringent requirements that all have to be met. And people do get hung up on these. They're not the most fun part. It's more fun to get strategic on things. But these are an all or nothing deal. There is a requirement for what type of property is going to qualify. There's 2 timing requirements. There's a requirement to use someone like myself called the qualified intermediary. You know, just like you have a person who is an administrator who's running your IRA, we have an intermediary that has to do the 1031 exchanges for you. There's requirements on how title must be held or who the taxpayer is going to be. And then lastly, there's requirements on how much you have to purchase in order to get the full benefit of complete tax deferral. Now, this is where 80% of the law really falls, is right here. So let's flesh these out real quick. The first basic requirement is that it must be real estate that is held for investment. And what that means is held for investment as in using as a trade. Maybe it's a building that I have my restaurant in. Maybe it's business where I am actually a landlord. That's my business. I hold real estate to rent. I own farmland to lease out to tenants. Or maybe I buy property to hold for investment. What the IRS thinks about with this is it's property that you buy with the anticipation that it's going to grow in value. I would call that appreciation. But it's the idea that I'm going to buy it now because of what it's worth. It's going to grow in value over time. So whether you're using property for investment, whether you're making money on a property from the use of it, or whether you're holding it to appreciate, that is property that would qualify as investment real estate. As you can see on the bottom there, it's the use of the property when you sell it that makes all the difference in the world, how you're using it. So any property held for income or used to produce income can be exchanged for any other type. So one of the beautiful things about the 1031 exchange, we'll explore it a little bit more, is that whatever you're hearing in the market, you can adjust your portfolio so that you're the most advantaged. Maybe you started out in single family rentals, but now it's time to move into multifamily or commercial or industrial or raw land. The 1031 exchange, you can sell any type of real estate and purchase any other type of investment real estate. It does have to be U.S. property for U.S. property, or the territories of Guam and the U.S. Virgin Islands and the Northern Marianas Islands do count as domestic. So if you're really dying for that vacation villa on St. John's, you can make that happen with a 1031 exchange. but you cannot sell a rental in Omaha and use that to go purchase something in, say, Puerto Rico or Ireland. US for US, foreign for foreign. Now, the first of the timing requirements are that you have 45 days. And they aren't calendar days, so weekends, holidays, all count. The first day is the day of closing of the sale of your old property. During that period of time, you must have identified your potential replacement property or properties. There's two options that you actually have. You can either, during that 45-day period, actually take title to your new property and be done. But in any event, you do have another 45 days simply to provide a written list of your replacement property or properties. Now, I know that's for a lot of people that still doesn't seem like a lot of time, and I totally get that. But the IRS makes the rules, so that's what they are. So one of the things that we will counsel our people to do is that you need to be very focused when you are starting the process of starting a 1031 exchange. You want to make sure you know where you want to go. You want to make sure you know what type of real estate you're looking for so that you're not trying to cast too broad of a net, that you can be focused. The other thing is that in this 45-day rule, it is perfectly fine to be under contract for your new property before your old property sells. You simply cannot take title to your new property until your old property has closed. So that's why we say it's perfectly fine to have it all lined up so you're under contract for your new property. You close the sale of your old property and immediately close the purchase of your new property. That lets you restart cash flow that much more quickly, and it eliminates a bunch of the angst with the 45-day period.
Dave, if you don't mind, I have a question just really quick, and maybe
Yeah.
you're going to address this right now. I hope I'm not jumping ahead too much, but the having a written list, who does that written list have to be provided to? Is that just to you as the qualified intermediary, or does it have to go to the IRS? Kind of, maybe that's what you're going to cover here on this slide. So sorry if I jumped the gun.
That is one of the nuances of this whole thing is it never specifies what it actually says. I can't make this stuff up. It's too crazy to not be true. It has to be in writing between parties to the transaction. So technically speaking, if you have an email correspondence trade with your realtor, that could technically count. But one of the things that the role of your QI is that they're monitoring all of this. So most QIs will require that it be in writing to them. The IRS never sees it until they audit you. But when they audit you, they'll want to see it. So it is an important piece of writing, but there's been times literally where we've had people on vacation and they come back and they miss their 45 days. We're going, you're done. You no longer have a valid 1031 exchange. And they're responsible. We were talking to our realtor about this property for weeks, and they show us an email chain, and guess what? That's in writing. It's also a specific identification. As soon as they show us the email chain, that qualifies for an identification. So in one sense, it's really loosey-goosey, but in another sense, this is oh so important. Now, there's some weird rules surrounding not how many properties you actually purchase, but how you identify them. If you identify 3 or fewer properties on your list, then it doesn't matter what they're worth. So you can sell a property for $100,000. There are good $3 to $5 million properties on your list. That's perfectly fine. Knowing that, of course, once day 45 passes, you can no longer change that list. And you're stuck with what's on it. So you're going to have to buy one of those $5 million properties. But if you name more than 3 properties, you can still do that as long as one of 2 things happens. Either the total value of your list is no more than 200% of the value of what you sold. So if you sold for 100,000, you could name 4 properties as long as their total was no more than $200,000. Or you purchase 95% of the value of your entire list. You ask me, why do we have to do that, Dave? Why did the IRS do that? I don't know. It may have been the fact that in the early days, in the mid-90s, exchangers would come into to our office back then, and they'd throw the LA County phone book on the desk and say, here's my replacement list. I think the IRS is trying to manage information flow. And so that's what they've done. They set this up. This hangs up a bunch of people trying to understand this part of the rule. So I'm glad that, Scott, you're going to have the recording. We've also got videos on our YouTube channel that go into this in depth. But the important thing is there's never going to be any individual extensions or exceptions. A hurricane, a wildfire might sometimes get a class of exception, but you're never going to get one for yourself. Now, concurrent with the 45-day period, you have 180 days from the date of the closing of your sale to actually take title to the new property. And guess what? It has to be one or more of the properties that are on your 45-day list. So if you close on it during the 45-day period, by default, that becomes your identification list. If it's after day 45, the only properties you can choose from are properties that are on that 45-day list. Up until day 45, choose anything you want. After day 45, only what's on that list. And I got to tell you, I had one of the saddest experiences this year with a client who had identified a whole bunch of lots down in Northport, Florida that he was going to buy. The problem was he didn't have them under contract, and he got out a bid for all but 2 or 3 of them. Well, he's past his 45-day period. He's got a ton of money that he's going to pay tax on. So this guy had to go to every person who had outbid him for one of those lots and offer that money in exchange for the privilege, in quotes, of buying that property from them for a higher price. That was not a happy day for anybody. So what's my takeaway on that? Be focused, move quickly, try to be as far down the road during the 45-day period as you can, but knowing that you've got 180 days to complete your purchase. And that can actually come into play very well if you're the type of investor that likes to invest in new construction. Because you might go into contract for your new construction property a year and a half before it's going to be done. And if you time the sale of your old property so that it closes within 2 to 3 or 4 months of when your new property is going to be done. See how that can work? You're under contract for your new property. You're taking advantage of a lot of the 180-day window to give yourself that flexibility. By the way, don't ever try to time that too close, because every builder in America seems to think that there's 45 days in each month. So when they tell you it'll be done in 2 months, that really means 3. Just my observation. Again, no individual exceptions, extensions. You're just not going to get it. But here's a bugaboo, and it illustrates something very important. You do have to have your 1031 exchange complete within the shorter of 180 days or the date you have to file taxes for the year in which your property was sold. So you might close a sale of property late this year, December, which means technically you get 180 days until like June. But your tax filing is going to come due in April. So you see the answer on the screen there. Simply file an extension. You'll always get the full 180 days. But what this demonstrates is that there is no penalty for starting and not completing a 1031 exchange. If you don't complete it, your accountant simply reports it as a sale and you pay the tax. If you do complete it, it will always be done before you report your taxes, and then they will report it as a 1031 with no gain recognized. So that's the key in the reporting there. Now, like we said, you have to use someone like me, a qualified intermediary, because it has to be documented with some specific documentation at the closing of the sale and of the purchase, and you cannot touch the proceeds. You can't have actual receipt where the money's in your bank account. You can't have constructive receipt where the money's in a title company waiting for you to decide what to do. And I do get these calls still every month, and they're sad calls as well, where someone will say, I closed on my property last week. I'm ready to do a 1031 exchange, and I have to just kind of weep with them and say, sorry, but you're not going to be able to do it this time. The qualified intermediary has to be in place prior to the closing of the sale. We have to be an unrelated third party, so we can only do your 1031 exchanges. I'm an accountant, my partners are attorneys. I don't do taxes, they don't do estate law. All we can do for people are process 1031 exchanges. And this is the most important, just reiterating, the QI has to be involved prior to the closing of the sale, so the documentation can be in place and so the proceeds don't touch your hands in between your sale and your purchase. Now, title requirements, or as I call them, the taxpayer requirements, really say that whoever the taxpayer is for the old property, what tax return is reporting that property, or whoever is on deed to that property has to be on deed to the new property, and the property has to continue to be reported on the same tax return as the old property was. When you're using a lot of liability mitigation tools, LLCs, trusts, and that kind of thing, sometimes we've got to track it back to find out who's actually reporting the property. Because sometimes it's not who's on deed. And in that case, we match up the taxpayer instead of the deed sometimes to make that work. But the taxpayer for the new property has to be the taxpayer for the old property. Now, the most misunderstood requirement of all, and the last one, are the reinvestment requirements. You want to think of this as basically a two-part rule. First of all, if you want to defer all tax, then you must use all of the proceeds that are generated from your sale in the next purchase or purchases. Secondly, you must purchase property or properties that are at least equal to or greater in value than what was sold. Now, there's a quick down and dirty way to figure this out. If you simply take the cash from your sale that goes into your exchange account, if you add to that the amount of mortgage that was paid off, then that total is your reinvestment goal. This doesn't mean that there's a requirement to replace the mortgage. There's not. You can bring your own money in. If you want to defer all tax, you've got to purchase at least as much real estate as the amount of cash generated plus the amount of the mortgage that was paid off. If you want to use your own money to do that, that's perfectly fine. So, two-part responsibility, use all of this cash to purchase the reinvestment goal. If you're used to working with settlement statements, it's also the reinvestment goal is also called the net sales price, which is your contract price minus closing costs and commissions, but not counting the mortgage payoff. So you might sell a property for $320,000, and there's $20,000 of closing costs and commissions. Well, that makes your net sale $300,000. And that's how much real estate you have to purchase in order to defer all tax. If there was a mortgage on that for $200,000, then you would generate $300,000 in cash. So you have to use the $300,000 in cash to purchase, I'm sorry, yeah, in order, I think I started this illustration out, would be a $300,000 net sale with two $500,000 net sale with $200,000 in mortgage payoff. So your net sale is $500,000. Sorry about that, guys. Confused myself for a minute. And you have $300,000 in cash. So you've got to use all $300,000. You've got to use all $300,000 in cash in order to defer and purchase $500,000 in real estate. Now, the reason why I use this specific example is that what it allows you to do is something called a diversification exchange. Because remember, we said you don't have to purchase only one piece of real estate. So you can take the $300,000 of cash and use that to purchase multiple properties. Now, let's say one of those properties was a $250,000 property that you paid cash for. But would you take the other $50,000 and you use that as a down payment on another $250,000 property? At the end of the day, did you purchase $500,000 your net sale? You sure did. Did you use all $300,000 in cash to do that? You sure did. But what happened? You have two properties where you sold one. You have a property that's free and clear, so you've concentrated your equity. You have a property that is mortgaged, so you're getting the arbitrage of the leverage on that. And if at any point in time you want to, you can simply do a cash out refinance of the free and clear property. So that's just one of the little hacks that can come from the reinvestment requirements. But whether you think of this as the net sale being your reinvestment requirement, or you use the cash plus debt relief model, it all equals the exact same amount. You got to use all your cash to purchase at least as much as you sell. Now, I always get the question, but Dave, I put $20,000 down on that property when I bought it. I don't have to pay tax on that. That's not profit. Why can't I take that out? I totally agree with you. That money's never going to be taxable. You don't have to pay tax on it. You should be allowed to take it out. But the IRS, being the IRS, chose to interpret it that any amount you take out from a 1031 exchange is not taking your original capital. You're taking profit. So you take the 20,000 out, you can do it, but the IRS is going to say that it's profit, and they're going to make you pay tax on it. You want to say that it's your original capital and not taxable, but when you do the 1031 exchange, they just don't let you do that. We all know who's got nuclear weapons, and I hear that the IRS just got like 40,000 handcuffs as well for their audit agents. So look out, they're always going to win that argument. So let's
Dave, if I can jump ahead, a quick question. Someone asked, I know you're just doing through that case study, but someone asked, what if there are multiple owners of the sale property? So I'm guessing, you as an individual only own 50% of it. Does that mean you just take 50% of those values that you calculate, and that's what you can then 1031 into your next property?
Well, that's exactly right, Scott. But there's a proviso on that, and that is that you've got to also go back to the taxpayer. So if there's multiple owners who own it as tenants in common, then you're absolutely right. Each one of them owns their own piece of real estate. It happens to be a percentage of the larger piece, and you're only going to be responsible for your percentage of ownership. But what if that property is held as a multi-member LLC. That LLC is actually the owner of the real estate, not the individuals, because we look at who the taxpayer is. And that multi-member LLC is reporting the activity of the real estate. So the individual members do not own real estate. They cannot do a 1031 exchange on their share of it because they don't own real estate. They own a membership interest in an entity that owns real estate. So the LLC actually has to be the exchanger. Does that make sense?
Yeah, it does. Yeah, another question somebody asked, and maybe this is, I know you're going to go through some of the basics here, but we're asking about, if you were transferring, you said like the like kind exchange. What if you're going from an investment property to a business, or vice versa, or residential to commercial real estate? How do those rules play with the kind of a quote like kind exchange? And again, if you're going to
Yeah,
cover
so
that here
there's
on the
actually,
basics, we'll take care of it.
yeah, we sort of talked about at the very beginning, but there's actually two phrases that the IRS uses: like kind and qualified use. Like kind simply means that it's held for investment, and that it's real estate. So any type of real estate that's held for investment is considered to be like kind. The investment portion of it is the qualified use. So it's like kind if it's real estate, it's qualified in use if it's held for investment. So you can't exchange into business assets except for the real estate component of a business. Like you wanted to buy a restaurant as a replacement property. You could buy the building that the restaurant is in, but you couldn't buy the equipment, the ovens, the inventory, and that kind of thing. It's got to be real estate, and it's got to be real estate that's held for investment. So that was, basics number one. Number two was the 45 days to identify, 180 days to complete the entire process, right? You've got to use the services of an unrelated third party called the qualified intermediary. And then what we just finished talking about was the idea that the taxpayer has to be the same, or the title for the new property has to be the same as for the old property. So when you're dealing with multi-member entities and that kind of thing, you got to pay attention to that. But if you simply own the property as tenants in common, then each one of you can do your own 1031 exchange on only your portion of that real estate. And then, of course, reinvestment, if you want to defer all tax, you got to purchase equal or up. So right there, in about 20 minutes, you guys got 4 years of accounting education. So don't feel bad if some of it kind of went where. But that's the basics that all have to be there. The most beautiful thing is that the requirement of using the qualified intermediary saves the day on all of this, because they have to be your guide through the entire process. So you're never going to be left on your own to try to make this work. So here's the fun part for me. How do we use them strategically? Well, consolidation exchanges come to mind very easily. If you've been an investor for a number of years, you've probably accumulated rental properties like Monopoly cards. And you wake up one day and you're tired. Why are you tired? Because you got so many properties and you're dealing with tenant issues and plumbing issues, etc., etc. Well, maybe it's time to take several smaller properties and use them to purchase one larger property. 1031 exchange is perfect for this. Sell 5, do exchanges on them to go purchase some $500,000 properties. Use the proceeds to go buy one $500,000 replacement property. You could buy something larger that's going to take less management. You could buy something larger that might have better dollars per square foot, like a multifamily. You could buy something in a different class of property, like moving into commercial property, where you've got less effort, you're managing a lease, you're doing triple net properties, so the tenant is paying the taxes, insurance, and maintenance. All of those are great kinds of candidates to start to consolidate your portfolio. You could also do what's called a diversification exchange, the exact opposite. You buy a property, you fix it up, you rent it a couple years later, you bought it for $200,000, now it's worth $400,000. So you sell it. Well, if you buy a $400,000 property, you can certainly do that in your 1031 exchange, but maybe in the market where you're at, $200,000 properties are generating $2,000 a month in rent, whereas a $400,000 property is only generating $3,500 a month in rent. So why would I want to buy one $400,000 property when I could simply buy two $200,000 properties and get more cash flow? Or maybe it's the kind of thing where I buy two properties. If one of them has an issue, a tenant leaves, I'm not left without any cash flow. So I'm starting to spread out my risk. Or maybe it's a situation where I understand the $200,000 rental market. I know where to find the properties to buy. I know where to find the renters. I know what kind of rehab to do to make it usable, and I know how to market them. With a $400,000 property, I mean, I don't know, where do I even buy those? Or where am I going to advertise for that kind of renter? Or is it something where I've got to use coriander or granite top, carpet, or tile? I just don't know that market. So I'm going to sell a highly appreciated property, and I'm going to buy multiple smaller properties that are in the market niche that I like. And this is what I call the ebb and flow of the 1031 exchange, because you can sell any number of pieces of real estate anywhere in the country, purchase any other number of properties anywhere else in the country. So you can sell in a highly appreciated state, go buy in a cash flow state. You could sell someplace where the market hasn't peaked yet, or has peaked, I'm sorry, and go buy in something where there's an emerging market. The 1031 exchange is going to allow you to, first of all, take advantage of the deferral of paying all that tax. So you get the benefit in your pocket of the deferred tax dollars and the profit that is made off the deferred tax and the profit that's made off of that profit. Secondly, though, the 1031 exchange can also be used to meet the market wherever it's at. The real estate cycle is predictable, but not when so much. Just we know the different changes that it goes through. And so you can use the 1031 exchange to beat the market wherever you find it for you in particular. Now, just like the 1031 exchange can be used to beat the market cycle wherever it's at, we could use the 1031 exchange to meet wherever you're at in your personal life cycle. I'm not the same investor that I was 5 years ago. I'm not the same investor today that I'll be next year or in 5 years. My needs change, my energy changes, the dollars in my bank account change, and you want to be able to use the 1031 exchange to meet that. The most poignant example of this is with retirement. And the best I can do is give you this real example of one of our clients, because it puts it all together. So we had a family farm owned by a couple, and they were getting ready to retire. So what they did was they sold their family farm. And the first thing that they did, because the family farm was composed of two different pieces of property, it was their primary residence, which we haven't really talked about that too much today. But if you buy a house and move into it and live in it for 2 out of the previous 5 years, then you can sell that and take the first $500,000 if you're married of profit tax-free. Yeah, not tax deferred, tax-free. That's massive because you can do that once every 2 years. It's called Section 121, and it deals only with your primary residence. Well, this couple sold the farm. The primary residence portion was tax-free. The rest of the farm, they went to their children and they said, hey guys, we've got to make some money in our retirement to replace the farm income. But if we let you pick out the property you want, would you be willing to manage it for us and split the rents with us? The kids loved that idea. So the mom and dad did a 1031 exchange, and they purchased a property for each one of their three children in three different locations. So they diversified, didn't they? They bought in different geographies, didn't they? Look at all the other good things that happened. First of all, they got somebody tax-free because they sold their primary residence. Secondly, they completely deferred the tax on everything else. Thirdly, they have motivated managers, don't they? Because their children are managing the properties for them. And fourthly, I didn't even realize this one, but Grandma figured it out. Every trip to go see her grandkids is a tax write-off business expense to go see their properties. And lastly, this illustrates the last D of 1031 investing. When mom and dad pass away, those children will inherit those properties at what is called a step-up in basis. So the parents will never pay the tax. The children will never pay the tax. The estate will never pay the tax. It all goes to the children tax-free. So, and Scott, we can agree to disagree on this one. I would almost say that one aspect actually makes the 1031 exchange juicier than a 401k. Because the one difference is when you finally have to start taking money out of your 401k, the IRS is going to tax you on it. All you have to do to turn tax deferred into tax free outside your IRA is die. So I don't know, you tell me which is preferable. I think they've actually both got incredibly important roles in your investing career and portfolio. To be able to use money inside your self-directed IRA to generate income that's tax deferred until you finally either convert it into a Roth or start your withdrawals. But outside your 401k, your self-directed IRAs, the ability to, during your entire lifetime, completely defer all tax and finally die and give it to your heirs tax-free is, in my mind, the icing on the cake. And there's one other thing that I want to mention before we open this to the last couple questions, and that is part of the retirement strategy also is that there is the opportunity to convert your rental properties, if you're using it for rental for a couple of years, into your primary residence. And as long as you own that property and live in it, you'll never pay the tax. So if you're wanting to retire someplace nice and warm, maybe what you do is a 1031 exchange and go buy a nice beachfront property in Sarasota, Florida, and then later move into it. Keep those deferred tax dollars deferred while you live in it till you finally pass away and your children get it. So many opportunities. You can learn a lot more if you click on that code there and go to our YouTube channel. By the way, I am so technologically challenged, I don't even know how to use these QR things. But actually, if you just point your camera at it, it highlights it in yellow and you can click on it and it'll take you right to the YouTube channel for the 1031 Investor. Would love it if this class was of value to you. to go to the other one and leave us a review. You'll have all our contact information as well. But yeah, what kind of questions, Scott, can I answer for everybody?
Great presentation, Dave. A couple questions popped in here as we have a couple minutes. So if anyone has another question they want to get asked, make sure you put it in the question box. The first one, someone says, if you own a 2-family home and are living in one part and renting the other part, can this property qualify for a 1031 exchange? I guess what are the rules on that if you have a property where part of it is rental, part of it is personal use?
You are living in the best of both worlds. You know what's called a house hacker? And that doesn't sound so glamorous by itself. But what it is, let's stay with the duplex example because that's real easy. When you sell that property, if you have lived in that one side for 2 out of the previous 5 years, then you get to take advantage of the primary residence exclusion, and the profit allocated towards that side is tax-free. Just put it in your pocket and go have fun. The profit that's allocated to the other side, you absolutely can do a 1031 exchange on. Now, let me see if I can make the valuations work out to be kind of fun. Let's say you're selling the duplex for $400,000, so $200,000 per side. So you do a 1031 exchange on the investment side for $200,000, but you use it as all of your cash as a down payment on a $400,000 duplex. Now, how much did you have to purchase in investment real estate? Well, you only had to purchase $200,000, didn't you? Which means that you could actually move into the other side of that duplex. So all the tax-free money from living in it, you don't even have to reinvest it in a new house to live in. You can let the 1031 buy enough real estate that you move into part of it. Did that answer make sense?
Yeah, absolutely. And so another question, this is something I know you covered at the beginning. Someone said they joined a little bit late. The location of the property, said they have a home in Puerto Rico that my siblings and I inherited. Are we able to do a 1031 to the U.S. or only in Puerto Rico or a foreign country? I know, like I said, I know you covered that at the very beginning. Maybe just recap those rules.
I didn't really mention Puerto Rico, but I didn't go into too much detail on it. Puerto Rico is a problem child because we would all love to invest there. What an awesome place, awesome investment opportunities. But the way that the government set the treaty up with Puerto Rico in the 50s is it is now what is called a commonwealth. It does not qualify as a domestic property for 1031 exchange. So you can sell in Puerto Rico, buy in Puerto Rico. You can sell in Puerto Rico and buy in the Dominican Republic. But you can't 1031 exchange from Puerto Rico into the U.S., unfortunately. Or I would be talking to you today, beachside from Rincon. Promise.
Yep. Another good question on timing, I guess. So someone says, how long do you have to hold on to a property before you can do another 1031 exchange with that property? So I guess if you were to 1031 into a property and now you're settled on the new one, is there a time period you have to hold that new property before you can 1031 into the next?
Yeah, great question. Oh my gosh, this is the deep weeds of the IRS. This is going to be the same answer if we were talking about someone who does fix and flips. How long do I have to own a property so that it qualifies as me holding it for investment? And the answer is there's no statutory holding period. The standard is your intent and how you can demonstrate your intent. And your intent must have been to hold the property for productive use in business, trade, or for investment. So think about the fix and flipper. They buy property primarily to fix it and sell it. They're not buying the property to hold it. As opposed to the investor who buys a property to hold it, so they put a renter in. So what's implied there is, one's longer than another, sure. but the IRS doesn't spell out how much longer that has to be. Most people feel comfortable with any hold of more than a year. As a matter of fact, there used to be a mantra in our industry, a year and a day, a year and a day. There was no magic to that other than 1 year turned it into a long-term capital gain. And that extra day always meant that no matter when you bought it, it was going to be reported on 2 consecutive tax returns because you owned it in 2 consecutive tax years. And that you would have also owned it in 2 consecutive calendar years. So very artificial. There's no magic to that. It's all about what your intent is and how you can demonstrate that. And there might always be some reason why a hold period of shorter than a year is appropriate. I mean, did the property next door to you become a meth lab? Or what about my favorite client of all time, who sold his property 3 months after buying it? And when I challenged him why he was going to do a 1031, I said, your intent doesn't look too good here. He goes, no. You understand, the only reason I'm selling it is because a bear moved into the trash container area. And my client left because she didn't want to have to mess with a bear. I sent the ring photographs to my accountant. He says, we're good. We can demonstrate our intent because the IRS isn't going to argue with a bear. It's all about intent.
Yep, and a couple questions like that we may not have. If we don't get a chance to get to your question, make sure you reach out to Dave. Did have just a couple more I want to get to. One was, how can you turn a personal property you live in to a rental and then 1031 it? If there again, going back to the timing, is there a time frame of how long you might need to rent a property before you can then 1031 it?
Oh yeah, that's great. So just like you could convert an investment property into your primary residence, you can convert a primary residence into your investment property. You just change where it's reported on your tax return. That's no problem at all. Now, here's the cool deal. If you sell that property after converting it into investment, so that you have still lived in it for 2 out of the previous 5 years. So let's say you bought it, lived in it for 2 years, then rented it for 2 years and then sold it. Did you live in it for 2 out of the previous 5? You sure did. So you would still get to take the primary residence exemption. If you've rented it more than 3 years, you no longer qualify for the primary residence exemption, but that's plenty of time to go ahead and do a 1031 exchange. So we'll have a lot of clients that will move out of a primary and go ahead and take advantage of the rental income for a year or two before they sell it. Then when they sell it, they still get the primary residence exemption.
Okay. Question, just kind of a scenario here. Say someone says, if you have a property that you sold, let's say you made $200,000 in profit, but you want to take that $200,000 from that investment property and partner up with someone else on a purchase. Is 1031 applicable as long as you reinvest your full $200,000 value into this new property alongside your partner? Basically, can you partner up your investment?
Yeah, you're selling for $200,000. Let's say you want to go with a partner and buy a $400,000 property. You would need to take title to 50% of it. Say the property was $800,000 and you had 3 people you want to go into partnership with. You would need to take title to 25% of it. As long as your ownership is equivalent to the amount of property you sold and you use all of your proceeds to buy it, it's a great way to partner with people.
Okay. Hey, great answer, Dave. The last question, somebody just asked about, do you know any taxes? Said, how about tax attorneys that are familiar with 1031 exchanges? Maybe that's something they could reach out to you offline, but if you knew anyone off the top of your head, they said they basically did 1031 a couple years ago and wasn't comfortable that the CPA knew what they were doing, but I guess you don't necessarily need a tax attorney either, right? You could simply use you to do it. You don't have to have an attorney or a CPA necessarily involved.
Well, that's exactly right. Yeah, attorneys sometimes will do 1031 exchanges. Accountants very rarely, because accountants really want to focus on your taxes. And a 1031 is such a small part of that. So an attorney can't do a 1031 exchange, but there's this whole broad field of intermediaries like us where that's all we do. So generally you will get a better economy of scale going with a nationwide QI as opposed to an attorney who's only doing a few a year. But yeah, reach out to us. By the way, the best tax attorney, although he doesn't practice tax, that I've ever met, and I know because I call him about twice a year, trying to with questions. His name's Scott Maurer.
Well,
see, Scott's an attorney, but Scott, you know Brackett's law.
Correct.
Correct. Self-IRA side of things.
Yep.
So everybody, jumps in their niche, and that's when you want to build a good team around you.
Absolutely, Dave. Again, thank you very much for your time. Thank you everybody for who logged in today for the call, and appreciate you listening. Great questions we had, great interaction. So Dave, thank you again for coming on today. We'll love to probably have you back again sometime soon to cover this topic, as I'm sure there'll be some changes here and there that or different different market impacts when this 1031 is going to be more available to more people, or more people looking to use this tool. So thank you again for your time.